Hey folks, it's 9:05. Let's get cracking. For those of you who've only just joined, my name is Dave Beattie. I'm the Legislative Compliance Manager at HR Talk. We're going to be taking you through today's webinar. We've got 100 slides, some budget related, some legislative compliance related, and then some changes, and then just some interesting developments, in terms of what SARS are looking at, just to give you an idea of what's coming in the future. So let's just start with the budget. And as I've said there, it's unprecedented times. I don't know how many of you joined on the 19th of February with pen and paper to jot down what was going to be happening. I certainly did, and I'm totally shocked that the budget didn't happen. I didn't even know that that was possible. Anyway, we were soon told that there was no consensus amongst the GNU partners, and there'd be a new budget presentation on the 9th of March. Quite a lot of time between those two dates, and unless you were hiding in a cave somewhere, you would have noticed there was a lot of haggling. There was a lot of stuff in the paper, online, about who feels what. 12th of March came, and we were given a little bit more information, but still no certainty because nothing has been signed off. Since then, we know there's been significant hot trading. We know the biggest issue is the VAT. And the DA has been unhappy, as I believe that the VAT is a block to economic growth. I see this morning that everyone's patting themselves on the back and saying, no, everything's fine. We're going to get to the bottom of it. But this isn't fine. And what this does is this impacts our economy every single day. The rest of the world's looking at South Africa and thinking they can't get their act together. It's a nightmare. So the budget is going to have to get moved over the line. When that is, we don't know. As panel people, we continuing as normal. I'm going to show you the next slide. The tax tables are the same. There we go. But the whispers and corridors of government are that this might change. There might be some changes to sorry, I put the wrong table there. I'm going to have to, when I send it out, I'll send you the correct one. I'll put the property transfer tables there. Anyway, the tables are the same. There's challenges in that we have inflation, and let's just say that inflation is 5%. We have this concept of bracket creep. Normally in the past, government would say, oh, look, we're concerned about our people, and we've adjusted the tables for inflation so that you don't necessarily get put into another tax band. Now, if these are the tax tables for the third year in a row, bracket creep is going to be a serious problem. The bands stay the same, the rates, the marginal tax rates stay the same. Your lowest tax rate remains 18%, and your highest remains 45%. There's been some whispering, as I said, tax relief for certain bands only, and I put there it's unlikely to be the 45% bracket. There has even been talk about some sort of a super tax, but that has been put on the back burner because I'm literally going to chase people out of our country. I just put in a table here to show you a little bit about bracket creep. So, if you just look at the first line, you'll see, if you earned 190,000, what tax you would pay, and then you got a 5% increase, your tax would increase. If you go over into the next tax bracket, then your challenge is even more real. So, at the end of the day, what's happening is you're going to have less money in your pockets. everything up, your food, your fuel, everything is going to go up in line with inflation, and you're going to be earning less money. And due to the state of our economy as it is, times are tough. We do a lot of tax directives, and I can quite honestly say the last 12 months has been unprecedented in the number of people that have been involved in the retrenchment of. It's very scary. Bearing in mind what's going on in the US with tariffs and Donald Trump obliterating US aid, we lose sight of the fact of how much money the US has put into our economy, and a lot of that money is into so cutting that money is having a dire effect on people in South Africa. It's time for government to say, "Oh, look, you know what? We're an independent country. We won't be dictated to." But when we don't have money, which we quite clearly don't have, we rely on that type of money. So we are seeing the withdrawal of funds. Uncertainty is terrible, because if you're working in that industry, you're not going to want to stay there if you're not certain of a job in the future. So a lot of people will be looking for jobs. And at the end of the day, the people that are hurt the most are the people that those organizations are set up to look after. There's your rebates. No changes to your rebates over the 2 years. No changes to medical aid credits. I was a bit surprised here. There's been talk of the government doing away with medical aid tax credits, and starting to put the money away for NHI. But I think the fact that it's not changed is a good indication of where NHI, your national health insurance, is. And that is, really on the back burner. A lot of the huff and puff for NHI was, election talk. But at the end of the day, money counts. There's no money. It's difficult to borrow more money as a country, South Africa. So NHI on the back burner, medical aid tax credits stay the same. I put in this slide because this is something that's asked of me quite often, and that is medical aid for pensioners. Remember that if an employer is paying your medical aid when you go on pension, that doesn't constitute a fringe benefit. It's specifically the fringe benefit. And you can just look at the bullet points there in terms of the qualifying criteria. Interestingly, contributions made on surviving spouse are also not taxable. So if you the ex-employee die, your surviving spouse, if they still continue to get the medical aid, that would be tax-free. Tables. These travel tables change every year, and I have it on good authority. They change based on statistics that governments have in terms of their travel. So you'll see that various gains there. So if your car does not exceed 100,000, there's a fixed cost of 33,940, and then there's a fuel cost, and there's a maintenance cost. The most important thing on the slide, though, is for those companies that are reimbursing their employees for travel, the travel reimbursements tax-free amount has gone from 482 to 476. Now, a lot of that will be around the fuel price, and also the consistency of the various taxes, fuel levies, etc., that governments have imposed. We haven't seen changes in that space. So the government's calculations, the cost of travel has come down. But interestingly, I saw this morning the oil prices is hovering around $60, which is been for a long time. So, thankfully, the lower oil price is going to be slightly, it's going to be a help, because our rand price has gone through the roof. So, hopefully next month when the government look at the fuel price, the drop in the oil price balances against the depreciation of our rand, and then we don't pay more at the pumps. Subsistence allowances, every year we change those. So if you are paying a subsistence allowance to your employees, and you pay an actual incidental expense allowance, that goes to 176 Rand a day. And if you're giving your staff an amount per day for meals and incidentals, so in other words, you send someone away and you do not want to be dealing with reimbursements, you can give them 570 Rand and say to them, listen, we're paying for your accommodation, 570 covers your meals, incidentals, and all other costs. And then you don't have to keep slips because 570 or under is acceptable to SARS and you won't pay tax on that. As of 1 March 2021, we had the 176 that relates to your time spent away during a day. And just to take a step back, so we've always paid on the basis that you would go away for at least one night. In March 2021, it was changed so that you have maybe a crew going 2 hours down the road to do installation. They're going to be away the whole day. 176 Rand for meals and incidental costs comes into play. Now, in terms of subsistence allowances, as I've explained, if your employee goes to Countdown, just as an example, and it's 3 days, you can give them the 570 times 3 days. The second scenario was the actual day trip where they don't go away overnight. And people are often confused by the 176 Rand for that day. That is not a subsistence allowance. That is the amount that you can reimburse your employee up to. So those guys that you send down, out of town to do the installation, they would have to give you slips. So, for example, if they all had a Kentucky Rounder and a Coke, and that came to 100 Rand, they would have to give you the slips. You would give them the 100 Rand, and there would be no tax implications because the 176 Rand is more than the 100 Rand. If they all went out and had a seafood platter, and that was, then obviously you're going to have a problem because the SARS rate is only 176. So I believe that, if they are out, to 176 is fair game. Yeah, this slide just shows you the SARS interest rates. The only really important one for you is the fringe benefit for low or no interest loans, and that is 8.5%. That means that if you give your employee a loan more than 3,000 Rand, it ceases to be a casual loan. And if you don't charge them at least 8.5%, there's going to be a fringe benefit. So, for example, if you charge them no interest, the payroll system will calculate what 8.5% interest is on a monthly basis on the loan and tax that as a fringe benefit. And then, as you can see, if you owe SARS money, 11.25%. If they owe you money, 7.25%. Hardly fair. Your company's rate stays the same, 27%, so you don't need to worry about that. Your small business corporation tax stays exactly the same. It would only change if the tax tables changed, particularly at the lower level. And as you can see there, the first level is 1 Rand to 95,750. 95,750 is the rate at which every employee starts to pay tax. So there's no reason to change this table. And then your micro business rates, there's no change either. Here's your transfer duty rates, as per the slide that I incorrectly put into the presentation, slide 2, if I remember correctly. Slight changes, they always change the bottom band. And as you can see here, if you buy a property and it's under 1.21 million you will not pay transfer duty. So what governments are doing is they're looking after those people trying to get into the housing industry and punish them with the additional costs of transfer duty. Okay, I just want to go through a couple of budget lowlights. Yeah, clearly VAT is one of those. So the idea on the table at the moment is that we're going to increase that by the 0.5%, and then we're going to have another 0.5% in April 2026. So that's another 1%. I think the government's thought here is, South African VAT is still relatively low compared to world standards. But yeah, I think the comparison is not really fair because South Africa is not at those world standards. We don't have, people get upset with me saying that, but we do not have the level of taxpayer contributing the level of money that they do in countries like Europe. And also in countries like that, you're getting a lot more bang for your buck in terms of tax, in terms of services. South Africa doesn't have that. And we have a very unequal society in many ways, and tax is one of those ways. We have a very small percentage of our population paying the tax, and the reason quite clearly for that is there's a lot of unemployment, and there's lots of people who do not have anything. So I think governments are saying the effective 1% increase between now and as of 1 April next year is probably the way to go to generate the revenue to balance the budget. Now, is it? Maybe they're catching people based on consumption. You go and buy, you pay your VAT. We'll see later they have expanded the zero rating goods a little bit, but mainly aimed at the bottom level of society. But VAT has a huge impact on household spending and economic growth. So as I've said there's going to be some change to the zero rating VAT issues, but we're going to have a negative effect on inflation, and things are going to be worse. So there is this ongoing debate. I'm going to say this for the first but not the last time in this presentation. If government was really interested in sorting the economy out, they would work on cutting wasteful expenditure and also the expenditure on the bloated civil service. Civil service. So they're obviously not prepared to do that because that is also a vote buying process. And we've got duplication, and we've got a lot of people in government who do not have the skills. The process to fix that is going to be long and torturous. Some more lowlights. There's been no changes to your foreign income exemption. Just to expand on that a bit, if your employer sends you out of South Africa, just say to work in Zambia, you can get the first 1.25 million tax-free. So it's a concession for working outside the country under an employment contract. That was previously 1 million, and obviously we'd hope that it would go higher than 1.25 million. So if you are sent out of the country, you'll get the first 1.25 million exempt, and then you will start paying tax according to the tables on anything above that. Any earnings in South Africa are fully taxable. Then tax-free savings account. This was introduced quite a while back, and it was introduced to create an opportunity for a bit of tax savings for employees, taxpayers who wanted to save towards retirement. The government said you could contribute 36,000 per annum up to a maximum of 500,000, and there'd be no tax implications. We have inflation, but we don't have an inflationary tax relief there. Interest exemption, quite unbelievably, that hasn't changed since 2013. The government talked about encouraging saving. but do you know you're going to pay tax above a certain amount, and that amount is quite low? There's no incentive really to save. And then there's been talk about retiring off 30,000 government employees. That will save 11 billion. But what they don't tell you is who's going to replace those people, levels of skill they're going to have, and also what skill they're effectively losing. So that whole process is going to have to be fleshed out a little bit. I remember when I was at SARS, they offered a voluntary retrenchment scheme, and the only people that left were the good people who knew they could find other jobs. So, not really a great idea. And then, as I mentioned, the public sector wage bill, that hasn't been decisively addressed. I don't think the government, quite frankly, have got an appetite for dealing with that, because of all the people that are benefiting from employment. Okay, so I've reflected this as a highlights/lowlights, depending on how much you enjoy your cigarettes and alcohol. It's just an easy target. You know that every year governments are going to these areas. And I mean, just look at spirits, extra R5.97 for a 750 bottle. So, if you're into your whiskies, starting to get a little bit more expensive. But par for the course. The highlights in my book are there was no implementation of a wealth tax. There has been a talk of this, and as I said to you earlier in the presentation, there's only so much blood you can wring out of a stone. At the end of the day, your taxpayers are paying a fortune, and there comes a point where the people actually dig their heads into the ground and say, we're not doing any more. And I think we're at that point. And I think governments understand by someone in the 45% bracket. Add all the other VATs and fuel fees and any levy imposed by governments, we are paying a lot of tax, and we are not seeing the benefit of those taxes. And as I said to you, there are countries in Europe, Scandinavia, that have very high taxes, but you can see that you looked after. If you're ill, when you retire and you looked after. We don't have that in this country, so it's challenging. Do you want to lose those people? Because a lot of those people will head for pastures new if this wealth tax is imposed. I also mentioned earlier that there'd be additional items added to the VAT exempt list, and those include edible offal, sheep, goats, poultry, swine, bovine, specific cuts of head, feet, bones, tongue, dairy blend, and tinned vegetables. Some interesting things there. No mention of NHI. I didn't think there would be. As I said to you, there was a lot of bluster at election time about how the governments are looking after people, and it's not fair that the majority of the population don't get access to medical aid. Well, it isn't fair, but at the end of the day, this costs money, and the government, as you can see, have got other things to worry about at the moment. So, no mention of NHI. Your social grants had inflationary increases, no change to the CGT rules formula. Cryptocurrency, I was involved in a webinar not so long ago with SARS, and SARS are getting mountains of information on cryptocurrency. So, if you are dabbling in crypto or you dabbling overseas, don't think that SARS don't know. Their tentacles reach far and wide. The fuel levy and the road accident fund levy, that remained unchanged. I think that's clearly for obvious reasons. Moving on to ETI, employment tax incentive. So for those of you who don't know that, basically an opportunity that government is given employers to employ people in the 18 to 29 age category, more at the low level side, and in return, the employer would get PAYE deductions against their liability in the particular month. Legislation that's given us massive headaches. The legislation was rushed in many years ago. I think it was about 2013, 2014, just before an election, so the government could show how much they care for these low earners. And unfortunately, they didn't look at the legislation effectively, and we've had lots of problems. But these tables have changed once, twice, I think, already. I think this is the third change, and the main change is in the bottom line, where the threshold, salary threshold, has gone to 7,499. Previously, it was 6.5. So, governments are accepting there is inflation, so they have to change this, but they don't change other things. I've included this ETR wage test just for you to look at. So, the national minimum wage, the tentacles of the national minimum wage also reach out to ETR. It's important that you know which employees are going to qualify, particularly at that lower level, the national minimum wage level. And you can see the 3 criteria that I've listed there. Moving on to ETR months, it's important to note that as long as the employee meets the qualifying criteria, that amount counts towards the 24 qualifying months. Whether the employer claims it is irrelevant. So, you need to be keeping your eye on this, and you need to be making sure that you are getting the benefits. Otherwise, you're going to lose it. Remember that, if you miss a month, you don't necessarily lose it. As long as you claim it in that 6-month RP5 cycle, you're good to go. But getting out of sync in terms of qualifying periods can result in inquiries from SARS. So, yeah, just make sure your payroll or your payroll administrator has got that under control. ETR issues to note. I've mentioned this every year in my presentation, and we're starting to see SARS hammering employers. So there's a closer scrutiny on who is on the scheme. Are they real employees? Is there an employer-employee relationship? We got one the other day that is a perfect example. If you're going to take on learners and you're going to put them into some sort of a training program, and there's no intention of bringing them back to work for you, you're going to have a challenge. Now, I know that there's reasons why people do this, particularly in the BE space, but it's hard not to want to dip into the ETR benefit space as well. And in the audits that SARS are doing, or in their findings, they attach copious amounts of notes of what an employee is. And I think the most relevant of those is the most simple thing, and that is the employees must physically work. So you must provide your actual labor to your employee. So if you're going to employ a learner and you're going to say, listen, what we're doing is we're employing 20 people. For the benefit of South Africa, we're going to send them to a training institution for them to learn how to sew and use machinery, whatever. And they're going to then go and become productive members of society. That's all. But you're not going to be able to claim ETR for them. I've actually been involved in quite a few of these cases recently, and it's just and paste once SARS asks you the relevant questions. So, don't fall foul of it. Don't be convinced to enter into such a scheme that's going to come back and bite you. SARS will always look at the intention. So when they ask you questions, particularly before an audit or sometimes after an audit at SARS, we used to send follow-up questions, read between the lines, because they're looking at the intention of the arrangements. Having the contract say that they're employees and every second word is that they are employed, that's not going to help you. And then, the downside is you're going to get EPR reversed and there's going to be punitive penalties. Moving on to the two-pot system, also something that's been, causing us grey hairs for a while. We now have had two-pot claims, and I have it on good authority that there was 2.5 million applications. 200,000 of those were immediately kicked out due to the wrong IDs and the fact that people weren't registered as taxpayers. So SARS, what do? They bring people into the tax net. 200,000 people understated their tax income to lower their marginal rate. Now, why would you do that? Well, if you're going to get an amount paid out by the insurer, you're going to definitely want it taxed at 18% rather than 36%. So people lied on their applications and said that they were going to earn lower amounts, and SARS are going to be penalising these individuals. The largest percentage of applicants was in the 60,000 to 119,000 bracket. I would have expected that. The second largest percentage of applicants was in the 240 to 359. I probably would have expected that as well. 75% of applicants on the 31 to 51 range, so your prime working years. 45 billion rand has been paid out, and the average payout was 19,000. Good for SARS because they collected 12 billion from this initiative. And quite interestingly, every time SARS receives a directive for someone, it's an opportunity to issue an AA88 saying to the person applying for the directive, excuse me, Mr. Employer, excuse me, insurer, but this taxpayer owes us money, either assessed tax or admin penalties. And those people who were applying for two-pot withdrawals would have had an admin fee taken off, and then they would have had a SARS tax taken off, and then they would have had the AA80 amounts taken off. So I'm pretty sure there was quite a few people who ended up getting nothing. So what was the money used for? 70% to pay off debt or some form of living expense, car payments, maintenance, general account, school fees. I think that's probably reasonable. That's where your average South African is hurting. Anyone who's got debt is hurting. And yeah, a lot went towards household items, essential living. So that tells me that people are living beyond their means. Bracket creep is catching up. They've spent more. They're incurring interest. They probably financed another car, bought a house, and now they're hurting. Surprisingly, only 10% went on luxuries. I wasn't expecting that. In terms of awareness of the impact of all of this, 70% of people aim to claim again. That's very concerning. 86% were happy with their decision to claim. 96% know how their withdrawal will impact on their long-term savings, which is worrying. And 96% said that they were aware that they were going to be taxed on them. Now, I don't believe that 96% of the people are aware of the implication of their drawings. If you go and tap into your retirement funding, you are hurting that fund because you are taking money out of the pot where there is compound interest growth. So to get back that money, you have to pay in quite a lot. So unless you and you had to urgently get amounts of money, and now you've come out the other side and you've got your bonuses and your commission. uh, you can then start putting the money back. But I can tell you now, very few people are going to be in that position. I personally was involved in a fund where the broker was negligent and the financial sector conduct authority didn't do their job. What happened is um, he was charged. He subsequently died, and big audit firms came in and they spent 3-4 years tidying things up. And as a result, hundreds of thousands of my money disappeared. Now that hurts because those hundreds of thousands have been accumulated over a long period. And taking that earning potential out of your retirement savings will hurt you. The average cost for each withdrawal from the retirement industry was 357. Some were as high as 1,500. What we told is the FSCA are actually looking at those companies that rip the ring out of the admin fees. 7,700 employees have had deductions taken off their salary, but employers didn't pay it over. This has impacted 300,000 individuals' claims. So can you imagine the stress of you working for an organization, and that includes some government, and you're paying your provident fund of 15% per month, and you go to do a claim only to be told that there's no money in the fund. I think that would stress me out. So that's 300,000 people have been impacted, and that's only the ones we know of. Okay, so we also did have some challenges. We were told in advance that due to the massive volumes, there was going to be challenges with communication with these companies and websites and the like. There was challenges with tax numbers being wrong, or tax numbers missing, and ID numbers wrong, ID numbers missing. There was also payment delays. So yeah, some payments actually took weeks instead of the standard 48 hours. And then just lastly on that element, 850 retirement funds had to actually change their rules, and that was a legal requirement to participate in the two-pot system. Okay, so what is the downside of the two-pot process? Now that we've seen some history, many people drew too little, and the reason for that is obviously they didn't want to impact on their retirement fund savings too much, but they weren't aware of the cost and the tax implications. So I firmly believe there wasn't enough consultation. Things happened so fast that I was concerned that funds and employers wouldn't do the necessary consultation, but that's happened. And catching up in the long term, I've just explained that to you. To catch up what you've withdrawn is very, very difficult. Now, with the tax table staying the same, you potentially have got an increase for 2025 already. You may go to a higher tax bracket as a result of that increase. Well, that's going to impact your two-pot withdrawal if you decide to take another one. And then something that the Payroll Authors Group brought up, and that was SARS will probably be doing more reviews on taxpayers, because a lot of the people that are making two-pot claims receive an auto-assessment. Now, because you are receiving more than one IRP5, one from your employer and one from the retirement fund, you're not going to qualify to be auto-assessed. Now, a lot of people don't know how to do tax returns or can't afford to get people to do tax returns. So I was informed yesterday that PAXA were meeting with SARS yesterday afternoon to specifically discuss this. What systems were they going to put in place to deal with those people that would normally be auto-assessed and now would not qualify because of the two-pot system? As soon as I've got any feedback, I will do an article on that. The upside for two parts, taxpayers are more educated and more familiar with the process. So we hope that the next claims process will be easier. The funds are also now have had significantly more time to adapt their systems and gear up for more claims. Taxpayers are aware of the tax implications, and hopefully we're going to put a stop to the practice of people actually resigning from employment just to access their provident fund. Crazy, but if you're desperate, I can see why people would do it. And yeah, we call enforcing the fact that people need to save for retirement. Moving on to long service awards, this has relatively recently been relooked at by some. Included it again because I would say 4 or 5 of the people that I speak to in terms of wanting to implement a long service award have no clue about the qualifying criteria. And the qualifying criteria that I specifically mentioned are the initial 15-year unbroken working period, where that employee works for that period without leaving for one employer. Okay, so if you started and you worked for 15 years for the company, loyal servants, never ever wavered, never went anywhere else. After 15 years, your employer would be able to give you 5,000 Rand as a reward or incentive, and that would be tax-free. Then after 15 years, 10 years after that, your employer can once again give you 5,000 tax-free. If your employer pays it out for the first time at 20 years, then you would get 5,000 at 20 years. Then you would get 5,000 at 30, 5,000 at 40. Okay. So previously, the 5,000 Rand had to be in assets. That changed as of 1 March 2022. So you can receive cash, you can receive gift vouchers, you can receive Kruger Rands. Now, long service tax award, you must have met the 15-year or subsequent 10-year criteria. The value of the award must obviously be clear. And then the value of the award can be reduced by its value and 5,000 Rand. So, for example, if your employer chooses to give you 10,000 Rand at your 15th anniversary, you're going to receive 10,000, but you're only going to pay tax on 5,000 because the first 5,000 is free. I've then at the bottom of the slide put in the codes. If you're going to be receiving cash, the IP5 code 3622 is applicable. If you're going to be receiving some sort of a fringe benefit or assets, then code 3635 is applicable. So the sum of code 3835 and code 3622 become the value that is used to determine the tax due. You might get 5,000 Rand cash and 5,000 Rand in terms of some sort of asset. SARS would only tax the 5,000 Rand that exceeds the threshold. Okay, this table I did also include last year, and let's just go through maybe 1 or 2 of them. You got 8,000 Rand cash. So we know cash goes to code 3622. And we know that only the first 5,000 Rand is tax-free. So in this case, the employee is going to pay tax on 3,000 Rand. In this case, the person didn't meet the criteria. They received 8,000 Rand. They're going to pay tax on 8,000 Rand. Third scenario, you get the use of a company asset to the value of 10,000. because you're receiving an asset and not cash, we're going to use code 3835. And the first 5,000 is exempt from tax, and you'll pay tax on the other 5,000. So you can go through that. You can just see the scenarios. You know, your first determination is, does this person qualify or not? Because if they don't qualify, then the exemption is out. As you can see, the code is different. You look at the second line where the cash of 8,000. You can't use code 3622 because it's not a service qualifying criteria. You have to use code 3601. So once you've done, does it qualify? Yes or no? Is it fringe or is it a fringe benefit? Is your next decision? What code does it go into? And then what are the tax implications if it's exceeded? Bursaries is probably my second biggest query of the last 12 months. And there's a lot of confusion as to bursaries to employees and bursaries to the employees' family members. If you give a bursary to an employee, there's no tax implication. If you give a bursary to a relative of an employee, there are tax implications. There's this element called the proxy remuneration, and proxy remuneration of 600,000 is a qualifying 600,000. You do not qualify for any concessions because the concessions are aimed at people obviously in the lower earning brackets. So in this case, yes, I earn under 600,000. Yes, I want some assistance for my children. The question I get asked a lot is, what is a relative of an employee? And SARS department is a member who's under your care and support. So it doesn't necessarily have to be your child. Okay. Bursaries and scholarships cannot be aimed at certain groups of employees. Obviously, that would get you into heaps of trouble and probably drag to the CCMA. You cannot implement a salary sacrifice and give your employee a bursary. And now what that means is, let's just say you're earning 100,000 Rand a month. You go to your employer and say, listen, I want to get a bursary, but I want it for my child. But how about you taking 10,000 off and then giving me the bursary? So obviously then SARS are going to say, no, your income is 100, it's not 90. You can't really top your income to 90. That's what we call a salary sacrifice. Because SARS are now going to pay tax. Well, SARS are going to get tax on 90, not 100. So don't enter into any sacrifice arrangement. SARS will look at people's previous remuneration, look at their remuneration now, and it doesn't take a brain surgeon to see if you've implemented a salary sacrifice. Bursaries and scholarships, it's critical that there's a clear contract in place with the employee in terms of the terms and expectations, particularly if there are payback terms. So if you fail, what are the payback terms? Okay. And what are the completion times? What is the expectations? How long should you work here to effectively pay off us for the goodwill of the bursary? Now, this table, what I've done is I've just summarized the amounts that qualify. And if you look at the first line, if you give an employee a direct bursary, as it quite clearly says, there's no tax implication. In the second case, bursaries, the 600,000 is your first determination. Okay, if they're earning under that, in the case of the bursary to a disabled employee, there's a 30,000 Rand exemption. That counts for your school-going years. Okay, if the person is disabled and they're at university, for example, the 30,000 becomes 90,000. And then probably the biggest bracket is bursaries for non-disabled relatives is 20,000. So if I give you, my employee, a bursary for your school-going child, I can only give you 20,000 tax-free. If I give you 60,000 for your university-going child, that 60,000 will be exempt in full. Okay, and then this slide is just the various codes, IP5 codes. You can have a look at that in your own time. Okay, so this slide is a good test of your knowledge. In this case, the employee earns 650,000. So the decision is quite simple. They earn more than the 60,000. Sorry, the 600,000. So you can't give these people any bursary that's going to be tax free. Second scenario, they receive 35,000 and they're only entitled to 20,000. And why? 20,000 tells you that they're in grade R to 12. So they're only entitled to 20. The employer gave them 35,000 in this case. So the 15,000 is a taxable benefit. Okay. The next line relates to, in this case, a qualifying employee where the employee's child or dependent is at university. And we know that is 60,000 and they were given 45,000. So they're going to get the 45,000 tax free. They could have got extra 15,000. Next scenario, and involves a disabled employee. They received 60,000 for basic education, and we know that a disabled employee in basic education only qualifies for 30. So the 30,000 becomes a fringe benefit. And then the last one is the employee's got a disabled relative in university. They received 50. They could have received 90. So the 50,000 is tax-free. Moving on to travel allowances, probably one of the biggies as well. In the fast start, SARS are looking at travel allowances quite closely because there's a lot of leakage from the fiscus in terms of refunds attributable to travel allowances. SARS know that this is an area that is widely used as a means of teaching SARS. So, yeah, just be careful. Don't be drawn into a scenario where you want to give an employee a travel allowance because they've heard it's a way of saving tax. You're going to be pulled into this issue, and SARS are going to tackle you if you've given the employee the opportunity to effectively commit fraud. It's very important that you look at the expenditure that the employee is likely to incur to generate the travel opportunity. So working with the employee to do this calculation, it would get you brownie points with SARS. To inflate the expense is bad because that enables the employee to actually go home and deliberately add extra mileage in because now they've got an opportunity to claim a bigger refund. Working from home created a huge challenge, and I have it on good authority that SARS are looking at this using their various audit tools. You know, if you're working from home, your expected mileage is going to be so. In my case, as an example, on average, I do 16,000 kilometers a year. That's dropped to about 10, just because I work mainly from home now. So I can't just add 16,000 next year. SARS are going to ask me how how I've come to start doing so much more mileage, either private or business. Also, you need to be careful that you don't, on your logbook, you don't put private mileage, because you are working from home now. So I was clamping down on the quality of logbooks. Quite a few queries came from auditors last year on logbooks. Not a lot of consistency, which is problematic. Some auditors require more information than others. If you, the employer, are reimbursing employees, then you've got a role to ensure that what the information that your employee provides you for business-related travel is set out in some sort of a logbook. And I mean, it doesn't have to be the logbook that a travel allowance uses, but it would be important to put the date of the travel, where they went, where they came from, who they saw, what the purpose of the meeting was, and then the business mileage. Not having enough information, if there is a query, can become significantly more problematic. Then the quantification of the fixed travel allowance. Your employer-employee relationship may change. You may go from a rep to a manager. You might go from lots of travel to little travel. You can't keep your same travel allowance. SARS are going to query that. They can say that it is not, the employer hasn't applied their mind. So obviously a rep would be doing a lot more mileage, and a financial manager would be doing significantly less mileage. It's important that if you give an employee a travel allowance, that there's actual mention of that in the employment contract or an addendum to the employment contract. And as I've said there, employers will be held responsible for poor decision making and not following good practice in this space. I often get asked how to calculate the optimal travel allowance. So there are the steps. I'm rather going to go through an example with you. And in this example, the employee's vehicle is 250,000. So as I showed you in the beginning, there's bands. So 250,000 falls into the 200 to 300,000 band, and the fixed cost element for that band is 87,497. So if we want to get the fixed cost per kilometer, we have to divide the total mileage that you expect to do in a year into the 87,000. So in this case, the employee is expecting to do 32,105 kilometers. So the fixed cost per kilometer is R2.72.5. Then on that same table, you just look across the band and you'll see fuel in that band is 1.779 and maintenance is 0.654, giving you a total cost per kilometer of 5.158 Rand. Okay. Now, we know that the employee did 32,105 Ks. So if you multiply the kilometer rates by the kilometers, you get 65,000. Divide that by 12. And in this case, the employee would qualify for a travel allowance of roughly 13,800. Always good to try and do this calculation. What I do is I utilize the employee's previous year's information as an indication of what we can go with this year. Now, if you do this, and you submit your tax return, there's not going to be any challenges. I've included this table. I have included this one before. Very important that you understand the various criteria. It's all summarized in the table, so there's no excuse for getting this wrong. We all should know that travel allowances are code 3701. We should know that if you're going to be reimbursed at the SARS rates of 4.76, That's going to go to code 3703. And then we know that there's code 3702. And code 3702 comes in if you reimbursed above the SARS rate, or you reimbursed and you're getting a fixed travel allowance. Okay. The only other code there that you need to know is code 3722. And if you reimbursed at more than 476, the amount between what you reimbursed at and the SARS rates of 476 is taxable. And that is taxable monthly. And it will go into code 3722. That'll be done automatically in your payroll. Okay, we'll just go through a couple of scenarios. If you only receive a fixed travel allowance for business travel, okay, obviously your employer will either tax 20% or 80% of that, depending on how much mileage you do. And then, because you've only got a travel allowance, code 3701 will be applicable. The taxable portion goes into code 4582. Scenario 2, the employee receives an allowance for fuel and expenses paid by the employer. So they don't get a fixed travel allowance, but the company pays for fuel, expenses, etc. That also is taxed on the 80-20 basis, and it is taxed as a travel allowance as well. So the same codes, 3701 and 4582, are applicable. Scenario 3, the employee is reimbursed not more than the SARS rates, and as we said earlier, code 3703 is applicable. It's a non-taxable code. Scenario 4, an employee is reimbursed at not more than the prescribed rates of 476, and they also receive a travel allowance. Reimbursement at 372. But in this case, because the person is getting a fixed travel allowance as well, the reimbursement has to go to code 3702. Fixed travel allowance goes into 3701, and the taxable portion goes into 4582. Now we're going to look at an example where the code 3722 is used. And in this case, the employee doesn't get a fixed travel allowance, but they're reimbursed at a higher rate than the SARS rate. Okay. So we know that the amount that exceeds the SARS rate is going to be taxable. And we know that that's going to, because it exceeds the SARS rate, code 3702 is applicable. And we know that the amount that exceeds the SARS rate must go to code 3722 and be taxable. So if you have an employee that's going onto the payroll and you're reimbursing him more than the SARS rate, maybe from month 2, he's going to come back to you and he's going to say to you, why is my tax higher? And you're going to say, no, because in month 2, you've got a travel reimbursement that exceeds the SARS rate. I've done a couple of examples here. Please, you can look at examples 1, 2, and 3 in your own time. I've spelled it out. I've done the calculations for you so you can see exactly what the logic is. And it's basically summarizing the scenarios that I've just explained. Moving on to learnership tax incentives, introduced way back in 2001. It's basically aimed to encourage skills development and job creation, giving learners critical skills where there is demand. Your employer, if they are making use of this incentive, will have to fill in the SARS 180 form, quite a lengthy form, but it enables SARS to view. Only the lead employer can claim this learnership tax incentive. Okay, that lead employer will be the one that pays the main remuneration to the employee. And then the of it is, if you have people on a learnership tax incentive program, you can get a deduction against the company's income tax. And the way that that is done is there's an annual allowance for every 12 months that the employee is on this program. There's an actual deduction from taxable income. And then when in the year of completion, the employer claims this completion allowance. So just as an example, if your taxable income was 1 million, and you've got 10 of these people, whatever the incentive is deducted off the 1 million so that you're paying tax on less than 1 million now. So there is an incentive provided by government to offer this type of incentive. Like with bursaries, this allowance increases if you do participate in the scheme with a person with a disability. And remuneration paid to learners is subject to PAYE. Yeah, so this table, you can go through it in your own time. It basically just shows you what those allowance deductions are. And as you can see, there's the annual allowance for learners with disability, without disability. Your NQF level is important. But if you have learners, you would go back to this table and you would notify your accountants to say, listen, when you're doing our calculation for tax purposes, don't forget the learner incentive, because we do have learners. Employee transfers. Okay, so just want to go through this very quickly. If you're going to transfer an employee from one city to another, that is the list of expenses. It's not a beginning and end list, but those are the most common expenses that your employee can incur and you can reimburse as an employee. What you can't reimburse is architect's fees for the new house that they're building in the new town or city and the loss on the sale of their previous residence. You know, if you're going to move someone to another town and you make them an offer, you know, in their head in terms of, is this beneficial to us? Am I going to lose a lot of money on my house? You know, if I don't go, maybe I'll be retrenched. So there's lots of decisions that have to be made. But it's important to have a policy. It's important to list the types of expenses that you as an employer are willing to pay. Now, if you're paying all those allowable expenses, you have to reflect that on your RP5 for that employee under 3714, which is a taxable claim. And then if they're non-qualifying expenses, they have to go into the other allowances taxable code. Employers are making mistakes is the legislation changed way back in March 2016 to say you can do the process of giving the person 1 month's basic pay. I'm saying to them, listen, it's a policy to give you 1 month's basic pay. Go and spend, reach that amount on your own. That fell away. So you have to work on expenses actually incurred. There's no maximum threshold, but I'm sure you as an employer want to have that open-ended. But as I said, have a policy on how the process works, what the most common expenses that you cover are, what slips they have to keep, proof of payments, etc., and how it's going to be reimbursed. Save all the paperwork so you don't get caught out. Moving on to foreign employment income. Before March 2020, South African tax residents could be exempt from foreign earnings if they met a certain days requirement. This was removed, making all foreign income taxable. Thankfully, quite quickly, there was a legislative change to say that the first million received out of the country would be tax-free, and that was then shortly after that increased to 1.25 million. So if you're an employee of a company in Durban and they send you to Senegal for 2 years to train people on the use of equipment, you can make use of this 1.25 million exemption. And if you earn more than 1.25 million, as I mentioned earlier, you will start paying tax on the amount that exceeds the 1.25 million. You might also be taxed in Senegal, so it's important that you look at what double tax agreements South Africa has. They do in Senegal. So, if you're going to be taxed on your income in Senegal, that can be offset against any tax you pay on that same income in South Africa. On a lengthy, challenging bit of legislation, if you've got employees working in the space with problems with dual taxation issues, let me know. Our sister company Sale works significantly in this space. One issue I forgot to mention is you cannot qualify for the 1.25 million if you are an independent contractor, government employee, or public office holder. You have to be working for under an employment contract, and you don't have to be working for a South African company under an employment contract. You could take a job in Senegal as long as it's an employment contract. You qualify for the 1.25 million. Just expanding on this a little bit. In South African law, residency means your legal rights to live in a specific country, typically through citizenship, permanent residency, or should you get a visa to allow you into the country. Now, residency is not the same as tax residency, unfortunately. Tax residency is, are you regarded as a tax resident in South Africa? If you are, you will pay tax on your South African and worldwide earnings. Okay. Now, tax residency is covered quite nicely in two interpretation notes. The first one is the physical presence test, and that is interpretation note 4. And then the more interesting one is the ordinary resident test, and that's interpretation note 3. If you need those, let me know. I'll email them to you. That basically sets out SARS practical application of the legislation to determine whether you are South African tax resident. Because obviously, if you are, South Africa wants your taxes. Anyway, okay, from 1st of March 2021, only individuals who have been non-tax residents for at least 3 consecutive years can withdraw their retirement annuities or preservation fund. So, quite interesting. A lot of people have just left South Africa. Okay, if you've left and you haven't gone through the process with SARS, you will not know whether you are non-tax residents. SARS determines whether you are non-tax resident by going through a process. So I've got lots of friends who are living in the UK, Australia, who have RAs and retirement savings in South Africa. They've been away more than 3 years, so they can make application to receive the money. But I can foresee problems when the retirement funds deal with SARS as to, is this person truly non-resident? And there's lots of people that are going to fall foul of this legislation. Okay, returning expats, you can read that in your own time. We're running out of time. I want to move over to UIF quickly. Online system that was introduced in 2021. This was meant to improve turnaround times. It's been a nightmare. Anyone who deals with Department of Labour or U-filing will know that it's a disaster. The system's down more than it's up. The reason for that is there's been service provider changes, there's been court action. It's a disaster. Communication is almost impossible. So I feel sorry for the people that urgently need to make claims. Now, if we're running your payroll or you're running your own payroll, you should be submitting a monthly EDEC file, with a declaration file. Um, and what that does is that updates all your employees' details with the Department of Labor, so that they've got a history of the employment with you. What you need to know is if there's foreign nationals on that EDIC file with foreign passport numbers or no South African ID, it's not going to update details for them. You have to physically go onto EU filing and update your foreign national information. Now, that is an absolute nightmare, but it's unfortunately the facts of the case. The UIF compliance certificate process, you used to be able to do that online. That fell into a heap, and Department of Labor have said that you don't require that certificate anymore to do work with governments. You'll have noticed there's a lot more UIF and TERS audits. We have it on good authority that everyone who claims TERS is going to get an audit. If you need help in that space, let me know. And there's talk of the National TERS Initiative being reintroduced. Heaven help us. COID, another bane of our existence. The COID threshold was only changed on the 31st of March. And that COID threshold is the maximum amount on which your fee will be subject to COID. So, for example, if you earn R1 million, only 633,168 will be subject to COID. Now, with that notification, we've also been notified that domestic employees will have a minimum annual assessment of 560. So if you do a return for your domestic and the calculation comes to 400 Rand, your assessment is going to say 560. And then all other employers, it's 1,621 Rand. So even if you submit a return saying your salary bill was 1 Rand, you're going to end up paying 1,621 Rand. Payroll systems are designed to deal with COID. So, it's good to put your COID rate into your payroll so that it can do a provision. Included in your annual return of earnings must be permanent employees, temporary employees, casual employees, learners, students. Okay. If you manage any of those categories outside the payroll, it's going to make submitting your return of earnings significantly more complicated. The return of earnings online system has been down recently, and that's in preparation for the deluge of return of earnings that are going to go in shortly and that are due by the 30th of June 2025. COID, what is COID earnings? Another hugely challenging topic. Your old COID returns, on the back of the returns, you would have seen what are earnings as referred to in part 2, and they give you included and what's included. The legislation changed, I think it was 2 years ago, to change COID remuneration to Schedule 4 earnings. So what Schedule 4 is your taxable, the fourth schedule of the Income Tax Act spells out what your taxable earnings is. So our interpretation and the payroll group interpretation of this is your COID calculation should be based on your employee's taxable income, not on the previous calculations as to what COID used to stipulate. Now, although the Government Gazette is issued, we've heard absolutely nothing from COID. So I firmly believe people are doing whatever they want this year. We've decided to be a little bit more prudent and take the new legislation into account, because we don't want there to be audits and then people to come, the auditors to come and say, listen, you owe 400,000 because you utilized the old legislation. So, yeah, hugely problematic, but yeah, it's a decision that you as an employer are going to have to make. A lot of the payroll companies have also gone that route and changed their software to utilize fourth schedule income. Just to clarify, COID earnings, it's an annual threshold, not a monthly threshold. So you cannot take the annual threshold and divide it by 12 and apply to earnings only over that 1/12. You could have a scenario where a senior employee in your organization earns more than 600,000 in the first 2 months. They would pay COID on that money in the first 2 months and then not after that. But we have had some challenges where we have what they call double dips, where employees move from one company to another in the group. They are going to have COID calculated on their remuneration in each of those entities, as per the way COID works. Okay, I have covered that. So more here as opposed to the previous declaration by the Compensation Commissioner. ECA threshold change, that changed as of 1 April, and most of you will know that is the overtime limits. So it went from 254,371.67 to 261,748.45. As a basic example, you are not eligible for overtime. Your employer can give it to you, but well, you don't have to. And then there's certain protections and there's bullet points under that that also apply to that threshold. We had a national minimum wage change. So the new minimum wage is 28.79. That also applies to domestics. Farm workers, the only exception will be extended public works employees. They only get R15.83 per hour. Okay, that's not a critical slide, nor is that. You can read that in your own time. PAYE and PAYE, just some information on that. Important. PAYE should be very important in your organization. You should have a PAYE policy. If you need help with that, let me know. And then PAYE returns, you need to be compliant. Otherwise, you're going to fall foul of legislation. Just some interpretation notes. Variable income. There's legislation that dictates the timing. Do you declare this on payments or accrual? Current tax year or previous tax year? Tax rate to be used across tax years. It's important. Generally, if you're outsourcing your payroll, that service provider will be talking you through that process. Draft interpretation notes was issued to cover employers' failure to deduct or withhold employees' tax. Your employer is liable to deduct the tax. The employee is liable to pay the tax. The employer can claim back from the employee if they haven't deducted tax. And SARS was saying that we're going to get our tax if we happen to get it from both employer and employee in places where there's been problems. So be it. I'm only going to very briefly talk about interpretation note 88. It involves massive payments that you might receive, sort of a retention bonus, restraint, or something like that, where you receive R1 million, you pay tax on R1 million, and then you leave. Okay. Well, what this legislation looks to do is how's this correction going to be dealt with in the payroll? There might have been an error. You might have got R1 million bonus. That's an error. Now, how do you correct that? Now, the legislation has been changed to say you can claim a deduction on a monthly basis. So if you owe your employer 400,000, they can say, look, over the next 12 months, we're going to take 1/12 of 400,000 off your salary, and this will actually go into a separate code on your RP5 certificate. It's not really a situation that's going to happen often. I mean, you don't get paid R1 million by mistake. But in these slides on interpretation at 88, please just look at the points. We've seen a lot of hijacking of e-filing profiles, quite scary. So just a reminder, use strong, unique passwords. Do not use the same password across all your platforms. I know that SARS has a two-factor authentication process now. Just be very careful dealing with any communication with SARS. When in doubt, rather phone SARS. And keep an eye on your account. If there's any funny things on your e-filing profile, rather phone SARS. Don't get caught up, because the next thing that change your banking details or something like that. Okay, this slide is just a reminder, basically, of the RP5 and EMP 501 process. You can go through that. We are going to be, if you outsource your payroll to HR Talk, we will be doing this process. But if you're running your own payroll, just go through those points, in terms of, are you doing the right thing? Have you tested the RP5s correctly? Are you dealing with validation errors correctly? Is your return actually in? Take a screenshot. Otherwise, we have had a situation in the past where we believe it's in, and then the next thing there was a problem, and we were being asked to waive penalties. PA88s, as an employer, I'm sure you love those. All it is a SARS way of recovering taxes that your employees own. I've just covered that slide again, because we've had huge problems with AA88s, duplicate AA88s. Always look at these codes. Does this issue require your attention as an employer? Okay, so for example, code 02 is an active AA88. You need to look at it. You'll have seen that the random amounts go all over the place, and it is very confusing. So look at the most current, and if in doubt, ask for help. And obviously, if the AA88's past its end dates, then you can ignore it. Okay, here's some new RP5 codes. None of these are critically important to the day-to-day issues. They're more for software service providers. Monthly RP5s, we discussed this last year. SARS want a real-time view of your earnings. They want to see what you as the employer are doing. They want to see whether you're complying with the accrual and payment basis for various payments, and they want more information. So we were threatened with this. SARS were pushing this, but they seem to have put this on the back burner. There's planned testing in September of this year, with parallel testing in March 26 to February 27. So you can already see this has been pushed out. And we've since been told that even the 26 to February 27 dates are probably going to be unachievable. So I was so busy working with AI and other search tools and getting information that this is going to get put on the back burner. Some SARS initiatives, as I said, AI. SARS are at the forefront of this. They're leading the charge. Data collection, they are at a different level now, in terms of where they're getting data from. So don't you think that you've got money in a tax haven, or you'll be in for a huge surprise. SARS are doing double checks on all sorts of things, even within South Africa, to catch people out. So expect more lifestyle audits. It's not worth lying anymore. Regularize your tax affairs. Just the SARS risk engine that I mentioned on the slide. A lot of NPOs were issuing Section 18A donation certificates where they weren't allowed to. That is being found out, and on tax returns being declined for non-compliance. You may have read in the paper about the traveller management system. So SARS know when you in and out of South Africa, and they're going to link that to lifestyle audits. High net worth individuals, anyone who has got more than 50 million is under the microscope and are being linked on. SARS are doing lots of webinars. I think we've got one tomorrow, particularly regarding the digital twins. The statements of accounts are going to be changed to prepare for the new monthly submission process. But as I said, that's on the back burner. Use of APIs, more data is being collected, electronically cleaned, and then applied. So don't be surprised in the future to have income on your tax return that you didn't even know about. E-filing, easy file are being updated all the time. And then this digital nomad visa. It's a 3-year visa. Applies to certain employees. And what I've done here is I've put a few slides together for you, particularly individuals who work remotely for a foreign employer or as a freelancer, and that allows you to live and work in South Africa. We all know that people can live and work basically anywhere, and all this is a formalization of, it's a visa to formalize relationship. Okay. So we've got a couple of slides on that. And then SARS initiatives. Look, resident and non-resident employers has always been a problem. What HR Talk have been doing is we work with our sister company to register companies in South Africa for our foreign clients so that they can get a PAYE number and comply. They don't have to do income tax returns, but they need a CIPC registration to get a PAYE number. So we can assist there. And then in terms of tax residency, for various reasons, individuals have decided to reinstate their South African tax residency. See a specialist, because you could end up paying huge amounts of tax and have cash flow challenges. So before you do anything regarding tax residency, speak to a specialist. SARS have relaxed the requirements to appear in tax court, so you don't have to be a tax lawyer anymore. You just must be qualified in your field, so a payroll technician, a registered tax practitioner, etc. Quite funny. Maybe not so funny if you're involved, but SARS are now going to be recovering legal costs from taxpayers who have dared to take on SARS. But unfortunately, it doesn't work the other way. So if you win your case, you can't get your costs from SARS. SARS have stated that 156,000 persons are not registered as taxpayers. Okay, so they're on the hunt for you. And shockingly, between 100 and 150,000 South Africans earn more than R1 million per annum and are not even in the tax net. So that will show you in a nutshell where our problems are. Spoken about net worth individuals. SARS are ramping up collection. I got quite a lot of lawyers' letters for certain clients yesterday because there's 350 billion in assessed taxes outstanding, and another 450 billion in appeals process. I mean, our problems can almost be resolved if SARS can sort those two amounts out. So, we're in a difficult position. Our economy is not performing. Government can't tax their way to growth. People are running out of fight. People are just not investing. People are saying, oh, well, I'd rather take my chances elsewhere. That's not good. We want money invested in South Africa. We want growth, but governments have to do their bit to create an environment where that's will work. And South Africans are very sharp people. They'll find alternate ways to make money, and those will generally be schemes and potentially be through tax evasion. So government have to be careful that they don't shoot the golden goose. I've spoken about wealth tax and retirees. Folks, that's the end. Sorry I've gone over the threshold a bit, but it's just a lot of stuff to cover. I'm going to be sending the notes out. I'll give them to Charlene straight after this. I'm just having a look at the chats quickly. Question on slide 53. Okay, look, if you're going to be moved, you can't be moved from Westville to Durban North. SARS are looking at more cases where you're being moved from town to town or province to province. Can you claim if you have to sell your property from the location? Well, yeah, you can't claim the loss on it. That's why I said it's important for you to, if the property market has hit the bottom and you capitalize in your house and your employer saying, well, I need you to go to Bloemfontein, and you get 2 million for your 6 million hits. SARS are not interested in the loss that you incur, unfortunately. In that case, it wouldn't make sense for you to accept that passport. I'm going to go through. As I said, you are going to receive these notes. I just want to make a correction. So just looking at questions and answers. Is that all, Charlene? Okay, that's all. So straight on with you. Sometimes getting a change on. Specifically want to reach out. Happy to have a chat. Just want to put my email address here for you. So let's see what I'm doing. Okay, so I've sent you my email address and my cell number. Happy to reach out to you, but obviously, if there's in-depth consulting required, I'll have to tell you, what the likely cost of that is. But thank you for attending and to support these webinars, and I hope you learned something. Have an awesome day. Thank you.